Good evening,
Please
sir.
confirm you can hear me clearly.
Good evening, sir. I can hear you from our end.
Yeah, Mr. Ahmed.
Good evening, sir.
All right. Our class tonight, let us see if we can conclude on divisional performance. Last week was a bit of disturbance in the course of the lecture. Tonight, we are going to demonstrate calculation in class. A quick recap of our discussion on divisional performance. We have discussed what is divisional structure, where a company is divided into various divisions so that each division will focus on its own primary business. A conglomerate company. What is conglomerate company? A company with different businesses. And these businesses are unrelated. When you say a company is conglomerate, a conglomerate company is a company with different businesses. And the businesses are unrelated. A good example is Dangote. We have Dangote company. Under the Dangote group, we have Dangote Cement that specializes in the manufacture and sale of cement. We have Dangote Salt, another division under Dangote Group that specializes in the manufacture and sale of salt. Cement manufacturing is different from salt manufacturing. Salt manufacturing is different from sugar manufacturing. Sugar manufacturing is different from Dangote petrochemical products manufacturing. This company, Dangote, is a conglomerate company. The company is operated along divisional structure. We now look at divisional performance evaluation. How can we evaluate the performance of individual divisions within the same organization? How can you evaluate the performance of different divisions within the same company? We now discuss performance evaluation, we discuss return on capital employed. That is the return on investment. Your return on capital employed is your operating profit divided by total capital employed. Your operating profit is the profit before interest and tax. You now divide this by your total capital employed. We equally discuss residual income. Your residual income is your operating profit minus imputed interest charge. Your imputed interest charge is the capital employed multiplied by the cost of capital. We explained these two last week. We now look at question number 2. For those that were in class yesterday, we solved question number 2. We solved question 2. Yeah, question 2, page 84. We solved that question last week. Tonight, let us start with question number 4. Please refer to page 85. 85/86. Yeah, let us look at Carosi Limited. Please check this. This question is question number 4. I think page 85. 85/86. Can somebody reconfirm this question, please? We need to move on. Can somebody reconfirm this question? We need to move on, please. Reconfirm the page. Carosi. Ahmed, are you there?
Yes, sir.
Please, can you reconfirm this question? This page.
The page is correct, sir. Good evening.
Page what, please?
85 and 86, sir.
85 and
thank you.
86.
Fine.
Yeah.
Please, it is always good to follow the question. We go to it. Carosi Limited makes quality wooden products such as table, chairs, benches, and door. Historically, the company has used many financial performance measures to assess the performance of the company as a whole. The company's chief executive officer has just been informed of the balanced scorecard approach and is eager to learn more. Carosi Limited has two divisions, X and Y, each with its own cost and revenue stream. Each division is managed by a divisional manager who has the power to make all investment decisions within the division. The cost of capital of both divisions is 15%. Historically, investment decisions have been made by calculating return on investment of any opportunities. And presently, the returns on investment of each division is 18%. A recently appointed manager for Division X strongly feels that using residual income to make investment decisions will result in better goal congruence throughout the organization. Each division is currently considering the following separate investments: Division X, Division Y. Capital required for the investments is given. Revenue generated from the investment is given. Net profit margin is also given. The company is seeking to maximize shareholders' wealth. Requirement A: describe the balanced scorecard approach to performance measurement. What is balanced scorecard? Explain balanced scorecard. You may be asked to explain balanced scorecard. Let us run through this first. Requirements 1. Balanced scorecard is a strategic management tool used to measure performance A balanced scorecard is a strategic management tool, a management technique used to measure organization performance from 4 different perspectives. Ladies and gentlemen, you are going to read and memorize this. It may be in your exam. What are the perspectives? First, balanced scorecard is an approach to performance management that considers 4 different perspectives. An approach to performance evaluation that considers 4 different perspectives. What are these perspectives? 1, financial perspective. Financial perspective measures financial performance. Such as revenue growth, profitability growth, return on investment. You must look at the company's financial perspective. As an investor, for me to invest in your company, I'm going to ask myself, what is this company financial perspective? How do I perceive the company financially? Please pardon me for this example. If a lady is going to marry a man, the lady will consider your financial perspective. It is natural. You are trying to invest your money in a business. You are going to look at that company. What is the company's financial performance? Is the company generating revenue enough? Is the company profitable? It's a natural thing. We invest money for the purpose of making money. You are investing money in your career with an expectation to make more money. Let nobody deceive anybody. Financial perspective is the number 1 perspective. Number 2, customer's perspective. Customer's perspective measures customer satisfaction, customer's loyalty. As a company, you are going to ask yourself, how many customers are satisfied with my service or my products? How many customers will buy my product and be willing to buy the product again? What is my brand loyalty? How many customers we stay with our product regardless of the price or regardless of competitors. Most customers, they have brand. You have your favorite toothpaste. If I want to use toothpaste, you have your favorite. There is something that is making you to be loyal to that product. So company must answer the question, how do customers perceive our company? How do customers perceive our products? Customers' perspective, we have impact on the financial perspective. If customers products, they will be to make repeat sales or repeat purchase. We also be willing to recommend your products or service to other users, other customers. Equity professional, we must ask ourselves, how many students will be willing to refer equity professional to other ICAN students? The students are our customers. We must ask ourselves, how many satisfied with our service, our lecture delivery, our video quality? Customer retention. How many customers will be willing, maybe after you pass your skills, how many students will be willing to enroll with us at the professional level? Customer retention. Customer perspective, we have impact on the financial perspective. Number 3, internal processes. Internal processes perspective. This measures the efficiency and effectiveness of our internal processes. This measures the efficiency and effectiveness of our internal processes, such as operational efficiency, look at our operations. Our operation is online services, physical class services. To what extent is these processes efficient? A company must ask itself, what do we need? What process or processes do we need to excel at? Where does your core competency lie? The company must ask itself, where is our core competency? Where does our strength lie as a business organization? Then number 4, learning and growth perspective. This measures the organization ability to learn, to innovate, and improve. A company must be creative. A business organization must be innovative. You must be able to learn new things, improve your processes. As a business organization, we must ask ourselves, to what extent is our company innovative? How many new products or new ideas have we been able to develop and sell to the customer? A company cannot afford to be static. Even an individual, you cannot afford to be static. The business environment is dynamic. It's always changing. Hence, company must learn to grow. You must learn to innovate. You must be creative. These are the 4 perspectives at which you can measure company's performance. If you enter a company, look at the company. Is this company innovative? Does this company create new products, new ideas? Once a company is not innovative, that company will collapse with time. You cannot bring in new ideas to your business. You can't bring in new products to the market. It will get to a point, customer will be tired with your product. At times, changing the brand, repackaging of the product, if you watch out. Look at most manufacturing companies. They will just rebrand their product. The same Coca-Cola. They will just change the bottle. Look at the example of Coca-Cola. At a point, they were putting names. You will see Sunday on Coca-Cola bottle. It's a strategy. Sunday, Chioma, Ali. No, by the time you just see your name, they just look at different names, common names in the environment. They now put common name. You know, human being, if you just see your name, Aurelua on a bottle of Coke, you get excited. Yeah, on a bottle of Coke, printed there, you get excited. What they are trying to do is to introduce, it's still the same bottle of Coke. They are trying to bring in new things. All right. That is balanced scorecard. Please, can you give me 1 minute? We now go to question number 2. I'm going to pause the class for 1 minute. Let me check this. I will pause the class for 1 minute. I will be back. Let's go on with the class. Now, requirement 2. Determine both return on capital employed, determine both return on investments, and residual income of the new investments for each of the 2 divisions. Let's go to this quickly. Requirement 2. Calculation of return on investment for the new investments. For each division. We take division X, or let's start with the formula. Formula for return on investment is equal to your profits divided by investments multiplied by 100. Now for division X, investment required is 88.2 million. Revenue generated from the investment, 46.4 million. Net profit margin, 30%. Division X, capital investments, 88.2 million. Revenue generated, 46.4 million. Net profit margin, 30%. What is the meaning of net profit margin? We are not giving the profit figure directly, but we are giving the profit margin. That's what's in place. Profit margin is profit as a percentage of revenue. This net profit margin means 30% of your revenue, 30% of the revenue is the profit. Yes, please, Joseph.
Yes, sir. Good evening, sir.
Yes.
So sorry, I joined the class lately.
Please hold, I can't even hear you.
So I joined the class lately. I want to know the page of our study material where I can. Sorry for the interruption.
Yes, Joseph.
So can you hear me now?
Please go ahead. I can hear you now.
Okay, sir. The page of our study material.
Eh?
Where I
Your
can find
line
this
is
place.
with when you're joining the class.
Okay, so let me shout you up.
Please go to page 85, 86. You are just joining the, at the start of the class we study. And it's on the question set. Let's go on with the class. Now, your profit margin percentage means profit as a percentage of revenue. That means 30% of the revenue is the profit. Profit is equal 30% of revenue, 46.4. Please derive your profits. That means profit is 13.92 million. Make sure you can mute. Once you have gotten the profit, calculate return on investment. Profit 13.92 divided by 88.2. Investment amount multiplied by 100. Please calculate return on investment for division X. 15.78%. For division X, the return on investment on the new project is 15.78. You have resolved that. Go to division 1. Capital investments, revenue generated, and net profit margin. This is 35%. Investment amount 46.0. Revenue 28.1. $46.0 million 28.1 million. Now get your profit in Naira amount. The profit is equal to 35% of revenue, 28.1 million. (35% multiplied by 28.1). This is equal to 0.834. Investment for division Y, the profit 9.835 divided by the investment required multiplied by 100. $21.38. Return on investment 21.38%. You have calculated return on investment of the new projects for both division X and division Y. Next, calculation of residual income. For the new investments. For both divisions. What is the formula for residual income? Please, let's extend this. Let's extend the margin. Please, just 1 minute. Let me copy for here. So please, I always believe that our students, honestly, I always feel that my students should be able to pass that exam. You also need to read what we study, what we discuss. We continue. What is the formula for residual income? Residual income, ROI, is equal to your operating profits. Profit before interest and tax. Minus imputed interest charge. Imputed interest charge is equal to capital employed. Excuse me, please. Multiplied by the cost of capital. You have all the variable required. Division X, Y. The profit here. In this question, the net profit is also the operating profit. There is no interest, there is no tax. Profit here is 13.92 million. Profit here is 9.835. You now come here. Capital employee, that is the capital investment. Capital investment or invested 88.2, 46.0 million. Cost of capital for both division 15%, 15%. Calculate imputed interest charge. Imputed interest 15% of 88.2. Capital employed multiplied by the cost of capital 15%. Here we have 13.23. $46 multiplied by 15%. Here you have 6.9. Assuming this is 1. This is 1. This is 2. Your residual income is equal to 1 minus 2. Profit, let me write this very well. Imputed interest assuming this is 2. 1 minus 2. 13.92 minus 13.23. This is 3. 13.92 minus 13.23. Here you have 0.69 million. $9.835 minus 6.9. Here you have 2.935 million. You have calculated return on investments as well as residual income for the new projects. The answer requirements 2. Comments on these results and taking into consideration the manager's view about residual income. Your comment is, should we accept the new project or not? Let us go to the comments so that you can appreciate why this comment is very important. Let's do summary of results. Summary of results. We have division. X and Y. Current return on investment for both division, 18%, 18%. New return on investment on the new projects, 15.75, 21.38. Residual income on the new projects, 0.69 million. $2.935 million. If you look at the question, look at these points. Historically, investment decision has been made by calculating return on investment of any opportunities. And presently, the returns on investment of each division is 18%. Now, the question is, question to the class. Look at the summary of results. Currently, division X is generating return on investment of 18%. You now have a new project. You are planning to invest in. That new project will give Division X 15%, 15.78%. Do you think Division X will be willing to accept the new project on the basis of return on investment? That is the question to the class. Will Division X be willing to accept this new project?
No.
Let me hear from no. Because currently you are earning 18%. A new project now want to give you 15.78%. You will not be willing to accept the new investment because it's below the return on investment you are currently earning. But look at it. Assuming residual income is used, the company with Division X will generate residual income of 0.69 million, which confirms that that project is good. If you use return on investment, Division X will reject the project. That means Division X will be rejecting a project that should have been accepted because the residual income shows that the company can generate additional income of 0.69 million, which will increase the wealth of the shareholders. To comment on this now. To comment on this. Comments. Division X will not be willing to accept the new investment on the basis of return on investment of 15.78%, lower than existing return on investment of 18%. However, if residual income is used, the new investments will generate additional earnings of 0.69 million. This will increase the wealth of the shareholders. The new manager is correct to say that residual income is a better residual income will result in better goal congruence. The new manager is right or is correct to say that residual income, to say that residual income would result in better goal congruence. You are done with your comments. There is no issue with division Y. You are done with the question. So please know how to tackle questions. We now move to the third method. We have solved two questions. The two questions we solved considered residual income and return on capital employed. The third method is economic value added. Economic value added. Economic value added can also be used to measure performance of divisions or the performance of the company as a whole. Economic value added is very similar to residual income. However, it uses economic profits and economic capital employed. I will take that again. Economic value added is very similar to residual income. However, it uses economic profits and economic capital employed. Unlike residual income that uses accounting profits and accounting capital employed. Unlike residual income uses accounting profit and accounting capital employed figures. Accounting information, accounting profits are subject to distortion and manipulation. Financial accounting information is subject to distortion. Because the accounting information is subject to distortion, the financial results may not represent the true value of a company. To correct this, if you look at accounting financial profit, is calculated based on convention and principle. We have depreciation. Depreciation is a non-cash flow. We have provision for doubtful debt. You are making provisions for something that has not happened. For this reason, accounting information cannot be used as a better measure of performance. To correct this, economic value added is introduced. Economic value added. Look at the value contributed to the business. Economic value, not accounting value. If you are to calculate economic value added, you are going to disregard accounting convention and accounting assumptions. You are going to look at those items that constituted value to the business. All right? To reduce the long story, how do we calculate economic value added? Economic value added is equal to no parts minus, open a bracket please, adjusted capital employed multiplied by the cost of capital. Your NOPAT is net operating profit after tax. To calculate your NOPAT, working one, calculation of NOPAT. Please look at it. You have your 2 naira sign. Pick your profits after tax. Now, items to be added. Items to be added. One, accounting depreciation. Charge. 2, provision for doubtful debts. Add back. 3, provision for deferred tax. Add back. 4, research and development costs. Add back. 5, non-cash item. Add back. 6, interest paid net of tax. Add back. Then 7, any other provision in the income statement. Your income statement, your profits or loss statement. Any provision in your profit and loss account, you are going to add it back. In the profit and loss accounts, add back. These 7 items will be added back. Please, you can document this format too and put in your notes. These 7 items, add back. Then items to be deducted. One, economic depreciation. Deduct. 2, amortization of development costs. Deduct. These 2 items will be deducted. Then you are going to get your notepads. At any point in time. This is how to calculate your notepads. Next. adjusted capital employed. Adjusted employed. Let's extend this more. Your 2 naira sign, you start with opening capital employed balance. Items to be added. 1. Operating lease assets. Add back. 2. Non-cash item. Add back, add back. 3. Increase in provisions. Add back. These 3 items will be added back. Less decrease in provision. Then you are going to get adjusted capital employed. Your cost of capital. Your cost of capital is WACC. Examiner may give you, or you can calculate yourself. Working 3. Cost of capital equal to weighted average cost of capital. How do you calculate weighted average cost of capital? WACC is equal to cost of equity multiplied by percentage of equity plus cost of debt bracket 1 minus tax multiplied by percentage of debt. These three variables that we have explained, and we have also illustrated, are required to calculate your economic value added. And please note, economic value added is directly linked to wealth maximization. Is one of the best methods of evaluating performance. Any question, please? So has advantage over residual income or return on capital employed. Misha, please go ahead with your comments.
Good evening, sir.
Yeah, we can hear you.
Hello, sir.
Yes, please go ahead.
Hello, sir.
Please go ahead. What do you try to mute? Go ahead, you muted.
Network is quite bad. I was trying to ask that you explain more on this net of interest calculation and on this part, the net of interest, when and how to identify in calculating it during it. And I saw where they added training cost of capitalization on that part.
Oh, that's excessive. So what I'm trying to say is, yes, if you look at the adjustment is like 83. The adjustment to that, when EVA was introduced, He has a lot of adjustments. However, your income statement may not contain all these adjustments. Training, development, cost, research. They all fall under development cost. It is even better to explain more with questions. It's better to explain, to demonstrate this with questions. Because the adjustment item is like 88 or 83. Only few of these reflect in the account for most companies. You know, account is a summary. Oh. How we can take questions, sir? Yes, we can. Let's look at question 6. Question 6, page 88. You are going to see that the adjustments is not as difficult as the long list. Please check page 88. Uzo Chooks. Page 88. Question 6. Uzo Chooks Nigerian Limited. Can we run through this question? Uzo Chooks Nigerian Limited is a company established 4 years ago to produce medical equipment. The income statements and statement of financial position for 2019 and 2020 as follows. You have the income statement. You have statement of financial position for 2019 and 2020. Other information. Operating costs include the following: 2019, 2020. You have depreciation. You have provision for doubtful debt. You have research and development. In 2019 only, you have non-cash item. Note number 2. Economic depreciation is assessed to be 50.5 million in 2020. Economic depreciation include any appropriate amortization adjustment in previous years. It can be assumed that economic depreciation and accounting depreciation were the same. Note number 2. Tax is the cash paid in the current year, 16 million. And an adjustment of 2 million naira for deferred tax provisions. There was no deferred tax prior to 2020. The provision for doubtful debt was 2.5 million on the 2020 statement of financial position. Research and development costs is not capitalized in the accounts. It relates to a new project that will be developed for over 5 years and is expected to be of long-term benefit to the company. Year 2020 is the first year of the project. The company had a non-capitalized lease asset of 18 million naira in January 2020. These assets are not subjected to depreciation. The cost of capital of who's or choose. Equity 18% cost. Debt pre-tax 6%. The capital structure. of use or choose. Equity 60, debt 40. The company had the opportunity to invest in solar projects that will require the procurement of an equipment worth 3 million naira in January 2020 and run for a period of 5 years with a salvage value of 0.5 million, generating a stable net cash flow of 0.85 million. The applicable cost of capital is the associated work of the company. Requirements A. Evaluates. Compute and evaluate the company's performance using average rate of return. Please note, the average rate of return is the same as return on capital employed. Please note, average rate of return is the same as return on capital employed. If you are to calculate this now, requirement A. Calculation of average rates of return. The formula is average operating profits divided by average capital employed multiplied by 100. We are using average because you are giving 2 years financial information. Without wasting time, take your year 2019, 2020. Your operating profit, profit before interest and tax. Go back to the question. Operating profits 70 million, 80 million. Look at it here. $70, 80 million. What is the average? Average operating profit. $70 plus 80 divided by 2. 75 million. Next, your capital employed. (2019) 2020. Capital employed is shareholders fund plus long-term debt. Shareholders fund long-term debt. Go and look at your financial. Shareholders fund here, 400 million, 445 million. Long-term debt, 100. Please stop touching my screen. 400 million, 445. Long-term debt, 100 million, 100 million. Capital employed in 2019, 500 million. 2020, 545. Find the average. Average capital employed. Is equal to 500 plus 545 divided by 2. 522.5 million. You can calculate average rate of return. Average rate of return is equal to average operating profits divided by average capital employed multiplied by 100. (14.35%). You are done with the 4 marks.
What is it? Huh?
Requirement B.
Which I'm busy.
Compute and evaluate the performance, the company's performance using economic value added parameter. What is economic value added formula? Let's go to this. B. Calculation of economic value added ever, no parts, minus employed multiplied by cost of capital. Working one. Calculation of no parts. Now, please note, if you are given 2 years, you are going to calculate for the most recent year. You cannot calculate average forever. So we are going to calculate for 2020. In this question, we are given 2019 and 2020. You are going to calculate for the recent, most recent financial year. Go and pick your profit after tax. For 2020. $48 million. Joseph. If you have something to say, let me always know. $48 million. Items to be added. Depreciation. That is accounting depreciation. Let's go and check. Look at additional notes. Depreciation for 2020. 28 million. Add back. Provision for doubtful debt. 2020. 1.2. Add back. Research and development for 2020 nil. Other non-cash item for 2020 3 million. Please add back this item. $28.0 provision for doubtful debt. $1.2 million. Research and development nil for 2020. Non-cash item 3.0 million. Provision for deferred tax. Let's go and look at the next notes. Look at these notes. Tax is the cash paid. In the current year, 16 million. That's not my problem. And an adjustment of 2 million naira for deferred tax provision. Provision for deferred tax. $2 million. Add back. Interest paid. Net of tax. Let's go to the income statement. The income statement for 2020. Please look at this. Finance charge. Your finance charges. That is the interest. In 2020, 40 million. Now, net of tax. Remove the tax. Tax rate is 25%. Compute 25% and remove for 14 million. Here. Look at the working. Finance charge 14 million. Multiplied by 1 minus the interest. This will give you 10.5. These are the items to be added back. $28 plus 1.2. 28 plus 1.2 plus 3 plus 2 plus 10.5. 44.7 million. This will be added back. Forever. Just look at the format. Then items to be deducted. Examiner saying year 2020. Economic depreciation is 50.5. $50.5 million. Deducts. Amortization of development costs. Development cost was incurred in 2019. The amount is 5 million. Now look at note number 4. Research and development cost is not capitalized in the accounts. It relates to a new project that will be developed for 5 years. And is expected to be of long-term benefit. (2020) is the first year of this project. That cost of 5 million will be spread for 5 years. The cost was incurred in 2019, but it's for a long-term project. You can't charge that cost as one. You are going to spread it for 5 years. That is the meaning of amortization of cost. $5 million divided by 5. Please go ahead.
So I have a question regarding this research and development.
Please go ahead.
Is it because they said it was not capitalized? That's why we didn't put research and development for 2020. And now the one of 2019 will not be prorated in 5 years.
One is that in year 2020, we didn't incur development costs. No development costs, no research and development cost was incurred in year 2020. That cost was incurred in year 2019. That was why we didn't add it back to 2020 profits. However, that cost is for a project. That cost was used to develop a project. That project is for 5 years. The cost will now be spread for the number of years the project will run. That is the meaning of amortization of cost. The project
My question
will
is,
provide. Yes, please.
my question is, if this research and development, let's say we have a research and development for 2020, and they said it was capitalized, are we still going to spread it in subsequent years?
If it was capitalized, you are still going to spread for 5 years. You cannot take it in 1 year.
No.
Is that better, please?
After adding it under research and development for 2020, let's say this 5.0 was for 2020, we will definitely add it back while computing for more parts.
Of course. Assuming we incur this cost in year 2020,
yes,
you are going to add it back.
Then we are not going to calculate amortization for it in
You
same
add
year.
it back. It's going to calculate amortization. When you add back, that means you are not deducting the cost in full. When you add back a cost, the cost you have incurred, you add it back to your profits. That means you have not removed the cost. You now want to amortize. You now spread this for 5 years. That means in year 2020, only 1 million will be deducted. 2021, 1 million will be deducted. Is that better, please?
Yes, sir. No, it's just this disclaimer that research and development was not capitalizing to the account. So because I've seen a question like this where the
capitalizing cost. Operational cost is a revenue item. It's we call it items of the income statement. That operational cost is an item of the income statement. But where a cost incurs, training, research, development costs, all those costs that we provide benefit for more than 1 year, like training costs you mentioned now. If a staff is sent on training, we now incur training costs. That training cost will not be treated as an operational cost. We are not going to charge it in 1 year. That training, they will now ask if the staff should return. We expect the staff to create additional value in the business. Now, say, okay, assuming the staff can create value for 4 years after trading, the cost will now be amortized. Year one, this cost will now, as the staff contribute to the business, as the staff generate revenue to the business, we also amortize the development cost into our income statement annually. We are not going to treat it as a one-off cost. It's not a one-off cost. It's a cost that will be spread for the number of years. The project or the product will provide benefits. Is that better, please?
Yes, sir. Thank you.
You now come here. I have like 10 minutes. Okay. This is 51.5. You can get your notepad now. $48 million plus 44.7. 48 minus 51.5. Your notepad is 41.2 million. Notepad 41.2 million. You have resolved notepads. Working to adjusted capital employed. Start with your opening capital employed balance. Go and check 2019. What is the closing capital employed? Look at here, please. At the end of 2019, capital employed was 500 million. What was closing for 2019? Because opening for 2020. Pick this figure. $500 million. Items to be added. Operating lease assets. Look at note number 5. The company had a non-capitalized lease asset. The lease asset will now be capitalized. 80 million. If you look at finance lease is automatically capitalized. Is assumed to be part of the asset of the company. Your non-cash item for 2020, 3 million. Add back. Increase in provision. There is increase in provision for doubtful debts. How do we determine this? Look at the provision in the income statement and the provision in the balance sheet statement for 2020, sorry. Please look at this. I've gone too fast. Look at 2020. Provision for doubtful debt, 1.2 million. Operating profits, that is, sorry, operating cost, that is in the income statement. Now look at note number 3. The provision for doubtful debt was 2.5 million on the 2020 statement of financial position. The provision in the statement of financial position is different from the provision in the income statement. The provision in the statement of financial position is higher. That means there's increase in provision. Determine the increase. 2.5 minus 1.2. That increase will be added back. 2.5 minus 1.2. 1.3 increase. Assuming it's a reduction. Assuming the provision in the statement of financial position is less than the provision in the income statement. That is reduction. You are going to deduct. So 18 plus 3, 21. I have 22. 0.3. This gives me 522.3 million. There is no decrease in provision. This is the adjusted capital employed. To round up, calculate working 3, your work. This is equal to cost of equity multiplied by percentage of equity plus bracket cost of debt 1 minus tax multiplied by percentage of debt. I'm trying to quickly round up the question. Look at cost of equity, 18%. Cost of debt pre-tax, 6%. Percentage of equity, 60. Percentage of debt, 40. Our tax rate is 25%. You can calculate your work. Cost of equity, 18%. Multiplied by percentage of equity, 60. Cost of debt before tax, 6%. Bracket 1 minus the tax rate. Remember, if you are calculating work, you are going to use after-tax cost of debt multiplied by percentage of debt. Please work this out.
12.6.
12.6%. You can calculate EVA, now you can go to sleep. EVA is equal to no parts. Our no part is 41.2 million minus bracket adjusted capital employed 522.3 multiplied by 1 cost of capital 12.6%. Please work this out. What is your EVA? Negative 24.61. The economic value added for this company is negative 24.61 million. Negative 24.61 million. A negative EVA implies a very poor performance. The wealth of the shareholders we reduce by 24.6 million naira. That means the company is not doing well. That means the company is not doing well. This implies that shareholders' wealth will reduce by 24.61 million. An indication of poor performance. We are done with A and B. Requirement C is another topic. You may do it to investment appraiser. Calculate NPV. I'm just trying to look at the time. Requirement C. Look at it. Calculate the NPV of the solar project for the life of the investment. Look at the last note here. The company had the opportunity to invest in a solar project that will require the procurement of an equipment worth 3 million. That is the initial investment amount. The project will run for 5 years with a salvage value of 0.5 million. That is the scrap value, generating a stable net cash flow of 0.85 million. The project will generate cash flow annually 0.85 million for 5 years. Your cost of capital is the one. Calculate NPV. This cannot take you 5 minutes. Calculate NPV of solar projects. Just open your schedule. Item, cash flow, discount factor, present value, year zero. The equipment cost 3 million naira. That's an outflow. Year 1 to 5. Net cash flow from the project 0.85 from year 1 to 5. Year 5 only. The salvage value. That is the scrap value. You can sell the equipment for 0.5 million. Examiners say the cost of capital is WACC. Our WACC is 12.6%. Find the NPV. Discount factor 12.6 year zero. This is 1. Year 1 to 5. That is annuity. The cash flow from year 1 to year 5, 0.85, 0.85, 0.85, up to year 5. Calculate annuity factor at 12.6% for 5 years. That will give you 3.55. Year 5 only. Calculate discount factor at 12%, 12.6%, year 5. That will give you 0.55. You can apply your calculator. Get your present value. Negative 3 million. $0.85 multiplied by 3.55. Here you have 3.0175. $0.5 multiplied by 0.55. Here you have 0.275. There the MPV. Sum up your present value. Final answer. 0.2925 million. The NPV positive. Once your NPV is positive, the project is financially viable. The solar project is financially viable. You are done. I don't want to leave that question unsolved. So please go through what we have done. All right.
Thank you very much, sir.
We have extended the class by 10 minutes. We got to move. I'm assuming there's no question. We are about to check out of this classroom. May God give you a better understanding. Let's have a blessed evening. Good night.